Welcome to everyone, and thank you for joining us. My name is Misty Bandy, and I'm one of the advisors with the Small Business Development Center at Southwest Virginia Community College. I'm here with my coworkers, Margie Douglas and Brittany Keyman, and we're very excited to be able to present this webinar to you today. In honor of the National Small Business Week, it's a pleasure to get to present this very informative webinar on business credit versus personal credit. Please note that this session is being recorded and that all participants are muted in order to cover the material in a timely manner. However, please feel free to type your questions in the chat and we will address them as.
You're muted. Misty, you're muted.
Not sure what happened there. Okay. Our presenter today is Sabrina Davis. She's the Vice President and Business Financial Advisor of Fulton Bank in Virginia Beach, Virginia. With assets of more than $20 billion, Fulton Bank has built a strong reputation in delivering the core promise to care, listen, understand, and deliver for their clients in Delaware, Pennsylvania, New Jersey, Maryland, and Virginia. Sabrina has and does provide high quality advisement in personal and business financial needs as a trusted advisor for the past 24 years. Her passion is to help clients and business owners with their financial goals and to help them prosper. So we are very excited to have Ms. Davis with us today, and I will turn the presentation over to her.
Well, thank you very much. And Misty, Brittany, and Margie at the SBDC, thank you so much for having me. I really do appreciate being here today and looking forward to hopefully providing and adding value to everyone that has joined us, and thank everyone for joining us. Today, our journey is really going to take us down the road of understanding the difference between personal credit and business credit, and add in a few additional add values in the middle of the presentation that can give you additional items to think about as you are probably joining us today because you're either thinking about starting a business, or you have already started a business, or maybe you're adding an additional project to your existing business. So regardless of the reasons you're joining us today, I'm sure that we can hopefully add some value there. One of the things that I wanted to give to you in advance is a disclosure. This particular information is for educational purposes only, and it's not really intended to be used for legal, tax, or investment advice. So I just wanted to put that up front, and thank you again for joining us. Thank you for the introduction, and just to give you a little bit of information of who I am, I've been a financial advisor for 25 years now, and whether it has been a mortgage loan officer or a district manager, small business banker, assistant manager, I'm trying to think of all the roles, private banker, broker, all of the above, you know, what I try to do is help my clients and the community, and of course, we're serving the community for Cedar Bluff in Virginia, understand some things that might get in your way and help you maybe put together some aha moments of things you might not have known, so you become more successful in your journey of running your business, starting a business, or taking it to the next level. And one of those most critical factors is understanding how personal and business credit plays a factor in your approval process when you're getting approved or declined for a loan, whether it's on the personal side or, more importantly, if you're looking for a business loan. And that's the reason why we've chosen to bring this information to you today. And as we are going into the first slide, we're really talking first as an agenda about the personal credit. Then we're going to slide into understanding the differences and how to build business credit. And then we're going to end hopefully giving you about 15 minutes of answering questions. As we go through the presentation, I'm sure that everyone probably or will have a question. So if you would put your questions in the chat room, and hopefully we can get to majority of them. I will tell you that I'm probably going to stay on for an additional 15 minutes past the top of the hour of 1 o'clock. So, but I want to be respectful, and I know that Misty, Brittany, and Margie also at the SBDC want to be respectful of your time. So you will be welcome to stay on just a little bit longer if you choose to do so. But if you have to drop off, we totally understand and respect that. So again, just as a reminder, if you'll put any questions that you might have in the chat room, if we're not able to get to all of them, I promise you we'll follow up with maybe an email where I can answer all of them for you. So with that being said, let's go ahead and get started. So I want to start by having a conversation of the importance of your bail team. And as you can see here, the acronym BAIL stands for the bank, the accountant, the insurance, and the lawyer. That is a really critical part of your business as you are trying to figure out strategies and put them in place to have a successful business. These are partners along with the SBDC that are a great partner for your team as you are starting or expanding your business. So when I think of banks, I am in that space. So let's talk about that particular team strategy. So each one of these acronyms, the BAIL for your team, we all have different business models, but I'm going to speak specifically to the banks and the credit unions. We all have different business models. All banks and credit unions are not the same. It doesn't make us a bad bank or a bad credit union. It just means we all have different business models. There are some banks out there that do lending for small businesses or startup businesses, and majority of them do not. And the reason why is because banks and credit unions are risk adverse. A lot of times they do not want to take on a whole lot of risk. So think about it. If you're a startup business and you don't have tax returns, you don't have generated income as far as for the business, then you become a little bit more risky for the bank. So therefore, you need to get out and interview at least a small, medium, and large bank and throw in the credit union, because you need to choose and interview the right people and advisors for your team. Just because that bank or credit union is right around the corner and convenient to where you're located does not necessarily mean they'll be able to help you in a full scope of what you need. So questions you may want to be asking is, do you help startup businesses? Well, another question you may want to ask is, do you offer small business administration government loans? Because SBA loans are a great resource for the bank to mitigate that risk and pass that on to the government, where we are able to approve you. Whereas before, if it's just a bank loan, we might end up declining if there's too much risk. So 2 questions. Do you do lending for startup businesses? Second question, do you offer SBA lending to businesses? And not all banks do. And even if the bank did offer SBA government loans, because there has been the impact of to the economy through COVID, and now there's several different variants going on as we are extended through our community, being able to be impacted negatively for businesses. A lot of the banks are focused on that time of the PPP, the Payroll Protection Program, and now that we have gone through that, now the second wave is being forgiven. So there's a whole process in being forgiven for the Payroll Protection Program. So therefore, a lot of banks have shut down doing borrowing with SBA lending, even if they did it before. So it's important that you ask that question. Are you still continuing moving forward offering SBA lending? So I stop there and talk about the banks and the credit unions and how we're all different. Well, accountants and CPAs are exactly the same way. They all have different business models. You'll find CPAs, certified public accountants, or accountants that offer a consultation role. And there are others that don't, that just do taxes and then charge you a fee for them at the end of the year, or should I say at the beginning of the year. In most cases, it's April that you're having to file. And of course, this past year, I think there was a couple of extensions because of the COVID situation and a negative impact to our economy. So accountants that are out there that you're looking for interviewing, you're looking for a consultative role. I'm here to tell you that if your relationship with the accountant and CPA looks like you're putting out a fire, it's a fire drill, if you will, you're trying to get in under the gun by April, you're rushing in, throwing a bunch of receipts on the desk of the CPA saying, okay, great, can you tell me if I'm going to get a money back or am I going to have to pay? I guarantee you, you're leaving money on the table. Because one of the top 3 reasons why businesses fail in some cases is they just don't know what they don't know. So that's the importance of the bail team. You need to know things that you don't know. And let's face it, you didn't get an education around accounting or insurance firms or even being an attorney. So you're really trying to pick the right partner for you and your business. Insurance and lawyers, all the same thing. There are different types of lawyers and attorneys. You know, I'm not sure you want to go out and start paying a corporate attorney $350 to $400 an hour if you are a small business. So you want to get out there and interview the right attorney and lawyer for you. For the insurance component for your business, it's the biggest overlooked piece, but should be one of the most important partners for your team. Insurance is just a way to mitigate that risk. If you are a partner in a business, you should have and consider maybe Keyman Insurance. So if something unnecessarily happens to your partner, let's say you're a landscaping company, you do and all the marketing, and you get out there and you bid on the jobs and run the employees to monitor and make sure they're doing what they need to do, whether it's landscaping or whatever that may be. And then you have another partner in your business that does all the book work. They're back at the office, they're answering the calls, they're making sure everything's getting paid on time. Well, let's say something happens to you where you're not doing the marketing anymore and it's negatively impacted the business and that scope. Will that force you to have to be put out of business, or will you have a strategy or maybe an insurance option available that keeps the business afloat until you're able to put that key man back in its place so it doesn't cause you to go out of business? That's just a very small example of the insurance space. And the important part to know is get out and interview your bail team. Interview 2 or 3 accountants, interview 2 or 3 attorneys. Maybe you have to interview even more, but you don't want to wait until you have to be provided that service to find the right bail team for you. You want to do that in advance. And if you're on the call today and you've been in business for a while, get out and really interview the right team for you as well. It's time to go back and look at the team you have in place, and are they the right strategy for you? Are they really rolling up their sleeves and helping you with the right strategy to overcome any risk, to overcome any challenges. Maybe it is to understand deductions for your business, write-offs, whatever the case may be. All of this team that you choose should be in a consultative role, helping you to figure out what you don't know. So that leads me into the topic of conversation of 3 reasons, in my opinion, over the 25 years that I really have stepped back to say, you know, some of my clients, or as I am helping the community, and I hear them tell me, well, I had to shut down my business. The top 3 reasons why they said they had to shut down their business. The number 1, lack of planning. If you don't plan, you're really planning to fail. And putting a business plan in place helps you mitigate that part of the risk factor for your business. It really helps you take a deeper dive and dissect all the things that you might not have known that you needed to put in place. So in my opinion, I highly recommend a business plan as you are maybe on the call for startup business or you're new in the business. Being able to put that business plan in place is really, in my opinion, very critical. And in some cases, if you need lending and we decide the right strategy is the SBA loan, then we will require a business plan for you to even apply for that loan. So another reason why a business plan is really important, in my opinion. Second reason, you just don't know what you don't know, lack of knowledge. And that's where that bail team is really important to help you figure out those things that you just don't know. Congratulations for being on the call today. And that's why I love the Small Business Development Center and what they offer you, because they really are putting those things out front to let you know these are the things that you need to know in advance. And if not, it's not too late. You're not alone. They're there to help you as a partner. As they are putting together, as an example, this consultation seminar today to help you understand what the importance of knowing business and personal credit is for you and your business. They don't want you to fail. So that is a great resource for you to be able to continue reaching out to, you know, Misty, Brittany, Margie, and the SBDC there at the Cedar Bluff in Virginia to continue your education piece and knowledge. They will continue to have and facilitate different seminars that you can continue to sign up for, and thank you for joining. The top, or the last third, or top 3, the third is lack of capital. So there is different seminars out there that talk about how to fund your business venture, understanding the differences between investors and banks and credit unions and what's the right strategy for you. So please reach out to the SBDCs and different resources out there, because they're all out there to help. There's the Women's Business Center, there's the economic development of each city, there's SCORE, there's different resources out there to help you. So, and they can help you figure out what the right strategy for you might be is. So let's get started and talk about, now that we're at 21 minutes after 12, talking about the personal credit scores and breaking down the 5 different factors of your personal credit score. And before we get into the 5 factors, I want to talk to you about a couple of things. As you know, there's 3 different credit bureaus for the personal credit. That's Equifax, TransUnion, and Experian. And please keep in mind, if you are looking to be a partner in business, in other words, you own 50-50% and the other person owns 50%, be very careful about who you go into partnership with, Because if you are a partner and you have great credit and your partner has challenged credit for whatever reason, you need to be very careful. Have that conversation up front, because your credit does not make their challenged credit good. You still will probably get declined. Because again, as I mentioned, banks and credit unions are risk adverse. And what is a credit score? At the end of the day, it's whether the bank or the credit union can trust you to pay them back. They just want to get their money back, right? So if you're not paying other bills, then we're going to consider that there is a high probability that you will not be able to pay us either. So that's the way the banks think of it. So if you're considering going into business with a partner, have that conversation. What's your credit score? And here's my credit score. And as we continue down this presentation or through this presentation today, we'll talk about what is a good credit score and what might be a challenged credit score. So this is where I stop and I say, look, there's no judgment. There could be different factors of why your credit might be challenged. It could be an unexpected divorce. It could be an unexpected job loss. It could be unexpected medical expenses that were out of your control. So no worries, no judgment. We're here to try to help you figure out a strategy to fix it. You're not alone. Please feel free to reach out to me if you need additional assistance. I do credit counseling. Now, it's different from credit repair. I will help you look at your credit and figure out a strategy that you can move forward on how to repair it. But I don't do the actual repair. As we move forward with the presentation, I'll give you some resources that you can reach out to if you wish to have an agency help you repair it if you want to. But after I review this information with you today, there is nothing that you can't do that a credit repair company can do for you equally. You can save the money and repair your credit yourself. And if you're on the call today and you have great credit, congratulations. What I'm going to do is take you on a journey of helping you understand how you got there and how you stay there. It's not just about you're paying your bills on time. There's a lot more to it. And then, of course, we'll wrap up with the business credit scores and how you can grow your business credit score and things that you can focus in on that. So let's talk about the Credit Karmas, the credit unions, the Bank of Americas, the Capital One, and there's different resources that are out there to help you manage your credit score. But I want to tell you in advance, that is not your score. It is a company that is taking their best guess at what your score is by a soft pull of your credit bureau that does not negatively impact your score when they actually do a soft pull. There's a difference between a soft pull and a hard pull, and we'll talk more about that. But it's not your score. The only way you can actually get what your score is from Equifax, TransUnion, or Experian is if you're applying for a loan or a line of credit from a lending institution. We are regulated and bound by having to send you a letter letting you know what the bureau that we pulled was of the three, or maybe we pulled all three, what the bureau reported your score to be, and 3 algorithms that you can maybe make it a little bit stronger. So I wanted to be very transparent with you because a lot of times I'll get a question, why is the score on Credit Karma, Equifax, different from me applying for the bank and my score is different with you? And there's your answer, because Credit Karma or any tool that you're using to take your best guess is just them taking a best guess. It is not going to be what your score is. Now, I love Credit Karma. Actually, I use a lot of Credit Karma with my clients. A couple of reasons. They use TransUnion and Equifax to give you their best guess of what the score is. They are pretty close to the 5 algorithms of what dictates what your score is, and they give you resources and tools in their program that's free to help you manage your score and keep track of it. So with having said that, let's get on to the 5 different algorithms of your personal credit score. 35% goes to your payment history, 30% goes to utilization, 15% goes to your length of history, 10% goes to the type of accounts that you have on your bureau, and the last 10% goes to inquiries. But let's take a deeper dive on each one of these factors. 35%. This is the Mac Daddy of your credit score. If you can't get this right, your score will always be challenged. You gotta get this one right. So there's more to it than just your late payments of paying on time or not paying on time. I usually like to facilitate by giving examples. So I'm going to give you an example. Let's say you have a $10,000 judgment and you have that's 3 years old. That's going to weigh less than your Pizza Hut collection that you just paid off from 5 years ago for $14. You can have a 680 score, which is fair, and have a judgment that's 3 years old in a Pizza Hut collection, because it's not just about the score. And the reason why is because this is a computer. It can only pick up how you're managing and handling your trade lines. So as soon as you pay that $10,000, or let's say in this case, the $14 Pizza Hut collection, you're actually going to plummet your score by 35% because you haven't touched your collection or judgment of paying anything for more than 3 to 5 years. So with having said that, it's a computer. It's not picking up that you have not paid or paid in 3 to 5 years. So that's why that score might be 680 or 700. But as soon as you pay that $14, your score is going to plummet probably close to in the 500s. This is a big factor of your score. And you're probably thinking, well, then I'm not going to pay off that collection. I'm just going to let it sit there because my score is pretty good. Well, when you come and apply with the credit union or the bank or any lending institution, we're going to pull the credit bureau. We're going to see the collection and we're going to give you a decline. Because if you're not paying them, there's a high probability that you won't pay us. Therefore, it's too risky. And we won't take on that risk. So the second factor goes to available credit. This factor is only about your credit cards and lines of credit. It's about revolving credit. So this is a second Mac Daddy high percentage of your score. So this is another one you've got to get right. So I'm going to give you an example of how this algorithm works. You can have a $2,000 limit on your Fulton Bank credit card. You can have another $2,000 limit of a Bank of America line of credit. And then lastly, you can have a $1,000 limit on your Capital One credit card. So let's talk about all 3 limits. If you add that up, that's going to give you $5,000 that you can go all over town and spend. But once you hit a $1,500 limit on your one card or a total of your $5,000, then you have plummeted your score 30%. Because this algorithm, you need to stay below 28% of all your credit limits added up. So if you take 5,000 and you take 28% of 5,000, that's $1,400. Once you go over $1,400, your score is going to plummet 30%. So if you see the credit utilization ratio factor on the right-hand side of your screen, you can see here that The green area is going to be anywhere from 28% or less. If you want to increase your score as quickly as possible, pay down your credit cards or lines of credits down to 9% or less. And then, of course, you can see here you're in the yellow all the way in the red if you're over 28% or more utilization on your limits. And here's the reason why. Credit cards were never meant for long-term financing. They were only meant for short-term financing. And the credit bureaus want to know if you're handling that product correctly. So if you're over your limits on your credit cards and lines of credit and you keep that balance on there for a long time, the answer is you're not using your credit cards and lines of credit as they were meant to be used. And things that you want to think about as you're making that decision. So let's say you're over 28% utilization. What is it that you can do to improve your credit score on this factor? So one of the things that you want to consider is simply just paying down the limit. If you think about the $1,500 balance on the example I gave you before on the screen, and you pay it down to $1,400 or less, and you've increased your score by 30% right off the bat, you can consider increasing your credit card limit. You can also consider piggybacking on somebody's trade line. Be careful, because if you piggyback on somebody's trade line and they don't pay on time, you could be piggybacking on somebody's challenged credit. So I'm going to give you an example. Let's say I do have a $1,500 balance and I have a $5,000 limit. You know now that my score has plummeted 30%. Let's say I call my grandmother and ask her if I can be added to her credit card from Bank of America that she rarely uses. She pays off to zero balance every month, and her limit is $20,000, and she has a zero balance, and she's had it for a long time. If she adds me to her credit card, that will give me a $25,000 limit at that time. Because I had a $5,000 limit on all three credit cards before, and she's adding me as an authorized user to her $20,000 credit card that she's had for a long time with a zero balance. So you add that up, and my limits are $25,000. And if you divide $1,500 balance now into $25,000, that will increase my score by 30% immediately within 3 months or less. Because all three bureaus will update every 30 days, and they're at different times during the month. So it takes 60 days for all three bureaus to have updated in real time. So let's talk about the third factor. 15% goes to your credit history, your credit history length, which means how long you've actually had credit. So generally, the longer your credit history, the better your score is on this factor. Remember, my grandmother added me as an authorized user to her credit card for $20,000 limit, and she's had it for a long, long time. I can actually piggyback on her length of history as well as she grows and adds me as an authorized user and continues to keep that card. So this is an area where if you are trying to clean up your credit, you've had credit for a long time, and there are credit cards out there that you don't use, but you've had them for a long time. As soon as you close them down, you are wiping out the history of the card. So be very mindful that if you're closing down a credit card, you're also closing down the history. It could, in some cases, bring your score down. So be very intentional before you do any of that. Research and make sure it's not going to negatively impact your score by 15% just because you're trying to do something which you're considering cleaning up credit. The fourth factor is the type of credit you have. Credit cards are third heaviest weighted. Loans, fixed rate, fixed payment, whether it's secured or unsecured, is second heaviest weighted. And your mortgage loan is the heaviest weighter in this algorithm for factor. So what's the difference between revolving debt and installment debt? So number 3 is a consideration which is least heaviest weighted in this category is what we call revolving debt. That's credit cards, lines of credit, personal lines of credit. Second heaviest weighted and first heaviest weighted is what we call installment loan debt. That's your student loans, auto loans, personal loans, mortgage loans. So you want to keep in consideration in that example that I gave you, if I have a $1,500 balance, my limit is only $5,000, and I take and pay that off and do a debt consolidation and put it on a loan, fixed rate, fixed payment, now you're increasing your score by 40%. And how that equates is you're increasing the 30% because you just paid off the utilization part, which is all your credit cards. You put it on a loan, which is increasing it by 10%. In this particular algorithm, you're taking it off the credit card, putting it on an installment loan, so therefore you're increasing your score by 40%. Now you can see how they start working together. Last factor, which is the fifth factor, is inquiries. Anytime you do an application and you get approved or declined, that is what we call a hard inquiry. That's an inquiry. It's going to stay on your credit bureau for 2 years, not 12 months, 2 years. So you can see here, hard inquiries stay on your credit bureau for 2 years. Delinquent payments of 30 days or more stay on your credit bureau for 7 years. Defaulted accounts, once you've paid them back and you're at a zero balance and they say that you have paid them, it's going to stay on your bureau for 7 years. Foreclosures and bankruptcies, anywhere from 7 to 10 years. So I wanted to be intentional in letting you know that if you owe somebody and you think that it's just going to go away, it's never going to go away, and the clock doesn't start until you've actually paid them off to zero. Then once you've paid them off to zero, that negative delinquent payment or defaulted account will fall off in 7 years once you've paid it off completely. So some product ideas that can help you, whether you are rebuilding credit or establishing credit, maybe you're building business credit, you can use a secured credit card. If you're building credit, you haven't had it before, maybe you're new to credit. And basically how that works is you giving the bank an amount of money. I'm going to give you an example of what Fulton Bank does, and just call me if you want to take advantage of any of these. I'd be happy to help. If you need a consultation, I do not charge a fee. I think that's another question I get a lot of. What fees do I charge if you choose to interview me to be your financial advisor? I do not charge. So Fulton Bank has a $300 secured credit card. You give me $300, we hold it as collateral, we give you a $300 limit, and there's no annual fee to do that. There used to be an annual fee, but because of COVID, it's something that we're doing for the community just to give back to waive that fee. On business credit cards, that can help you establish business credit score, and we'll talk a little bit more about that. We've got consumer credit card balance transfers. Right now we have 20 months, no interest, no annual fee, no for business and personal credit cards. You can get cashback rewards, a lot of different strategies that you can use in order to build credit or establish credit. Take a snapshot of this picture, if you will. We're going to stay on it for a quick second. This talks about what is a good credit score and what is a very, very good credit score, and maybe what it is more challenged credit. And it's expensive. If you have challenged credit, you're going to pay a lot more than somebody that has good credit. This is an example of a car loan for somebody that wants to do a car loan for, 5 years. Basically, if your score is going to be 720 to 850 right now, on average, you can pay around 3.6%. If your score is 500 to 589, if you get approved, you're paying anywhere from 15.24% or more. So it's very expensive to have challenged credit. Know that you're not alone. Reach out to those people and resources to help you figure that out. This is just an example of what a soft pull is. It's not a hard inquiry. It doesn't go on your credit bureau. Cell phone carriers, employment, insurance companies, they might pull your credit, but it's a soft pull and that does not stay on your bureau. How to repair credit. So you can pay your bills on time and make sure you're paying the minimum balance or minimum payment. You can set up automatic payments. You can apply for credit only when you need it. And just make sure you're following that 30% utilization algorithm. What about credit repair services? Well, it comes at a cost. They're going to charge you a fee. And as a reminder, you can do anything that a credit repair company can legally do for yourself. So you don't have to pay somebody to actually repair your credit. But here's some great information. Anybody that has challenged credit collections, judgments, maybe your score is lower than 680, you can go to the Consumer Financial Protection Bureau, and it highlights warning signs of credit repair services that are companies that are really trying to take advantage of you. Stay away from those type of red flags as you're interviewing the right company if you decide you want them to repair your bureau. And you can go to the Department of Justice, and they actually give you a list they've already vetted to be able to help you decide what's the right repair company service for you. So take a picture of this one as well. Checking your credit is important. You want to do that throughout the year. You get up to 6 pulls that does not negatively impact your credit score per year. And this is a way of being able to do that. Annualcreditreport.com, or you can go directly to Equifax, Experian, or TransUnion. So you want to keep that in consideration as you're looking at your credit bureaus. So this is where we're going to talk about the fundamentals of your business credit score. And I am at 15 minutes to 1. So 12:45, I'm going to go through this material a little quicker than usual, but I think you'll get a good general census of how to build business credit. So information that a business credit score contains is anything the bank provides, whether you're paying on time or not, investors, landlords, other companies, government agencies. They take in consideration your analysis of your credit worthiness, insurance underwriting, employment, licenses, terms, and business needs. The agencies collect information on bank accounts, payment histories, judgments, collections, tax liens, unpaid lawsuits. And here is how they clock you for your business, for your credit score. You need to obtain an ID number from the Internal Revenue Service. That's called your EIN number or TIN number. Most businesses acquire that when they're doing their state corporation commission, whether you're an LLC or incorporated business. You can even get an EIN number if you're sole proprietor. So then you become a member of the Data Universal Numbering System, which is dnb.com, and you can become a subscriber of a reporting service by submitting financial statements and registration information on your behalf for your business. So you actually have skin in the game to report for your business so you can come up with a good rating. And to ensure the most favorable rating, include the strongest or most well-established open trade lines of credit on your accounts for your business to the agencies. Here are the top 3. Most banks use Dun & Bradstreet. Experian Business or Equifax Business is another option for you. But if I were to be your advisor, I would advise you to spend most of your time with Dun & Bradstreet. Each of these agencies also have, like if you go to dnb.com, you get your DUNS number, you can actually pay Dun & Bradstreet to help you build your business credit score. But you can build on it yourself and report to Dun & Bradstreet those trade lines that are paying well. And in most cases, you're tracked anyway by your tax ID number, your address, and your state corporation commission. So each of the agencies usually provide a free business credit report. So those 3 agencies that I was talking about, this is what they'll do for you. Basically, they'll give you a free credit report for your business without applying for credit, so you can have an idea of what your credit score is for the business. And for additional fee, they will actually help you build your credit score. So business credit reporting includes information such as, in other words, your business credit report offers the bank this information: credit risk, potential business failure, credit filings for existence, business ownership, if you own another business, any public record for the business, and collaterals that you have for other business loans. That's what the bank is going to get when we pull the business credit report. So this is an idea of what the range is, and we call it PAYDEX range for credit scores. So you can see it's different for the business versus the personal credit score. So the rule of thumb for business reporting for your credit: incorporate your business, get your tax ID number, open a bank account that's in the business name. Keep your personal and your business separate. Register your DUNS number, open utilities for your business in the business name so it can be reported on your business credit bureau. Any revolving debt like business credit cards or lines of credit will be also a great way to start business credit scores. For instance, we have the business credit card, 20 months, no interest. You can even be a startup business and get that business credit card. Stop using personal credit for business expenses. Now, a lot of times if you're in the startup phase, what we do is we do a bootstrap technique. Sometimes you're using a little bit of business credit and you're using some personal credit. But it's important that as you're choosing your trusted advisor, you don't stay in that space. Transition any personal credit that you're using for business purposes eventually into the business name. Keep them separate and continue monitoring your credit report for the business. So this is a side-by-side explanation of what's the difference between personal and business credit. And I will tell you, the biggest difference is personal credit scores are private. You cannot just get your personal credit score. You have to either apply for a loan or a line of credit at any lending institution, and they are regulated to give you the bureau that they pulled and what the score was. It is not for the public. That's why these credit karmas and different ways that you're getting credit scores is not your credit score. It's just their best guess of what it is. For the business credit, it's not private. You can pull it anytime you want to. You just go to Dun & Bradstreet, apply for your DUNS number, and make sure you're getting your tax ID number up and running and build on that credit. And you can continue pulling your credit score from Dun & Bradstreet if you choose to do so. This is a resource page. And all of this information did not come from Sabrina Davis or Fulton Bank. This came from all of these resources that have gone into a lot of research. And you can continue moving forward doing additional research if you wish to continue your education around the differences between your personal credit score and your business credit score. So all of that to say this, it is critical if you are a startup business or you're in your start phase of 5 years or less, and in a lot of cases 10 years or less in business, that you understand your personal credit score is important, because we will ask you as a lender to personally guarantee the business loan or line of credit almost in every case to guarantee the loan. So although the debt is in the business name, we usually will ask you, and in most cases, 90% of the time, to personally guarantee. So that way we know that if the business fails, we can still collect our money from you personally. So when you're looking to be going into business or you're in business, you really need to be all in. And if the bank is asking you to personally guarantee it, that means we're going to pull your personal credit score, and that needs to be ready to go when you're ready to ask for a loan. And that's the reason why it's important for you to know that your personal credit score is critically important to get that right, as well as your business credit score. In a lot of cases, if you're new to business, you don't have a business credit score. You haven't had time to build that score. So what a great option is for you to be able to be a personal guarantor for your business and say, well, I'll use my personal credit score for you to be able to approve me. And we will, as a lending institution, as long as everything is in line and makes sense in your personal and your business credit score. Maybe your business credit score is non-existent and your personal credit score is good, we'll approve you. So those are reasons and factors you want to keep in consideration when you are applying for a loan. So at this time, I want to be respectful. It's 5 minutes to 1. And Misty, I think you had mentioned that maybe we have time for questions. I'll be happy to stay on until 1:15, but I leave that to everyone's discretion and want to turn it over to you now and see if we want to answer some questions.
Yes, we do have a few questions, so I will scroll down through these. I had a couple people ask, if you have a tax ID number, is it necessary to obtain that DUNS number as a startup to start building your business credit?
It is not required, because then you've got Equifax, you've got a couple of other entities that you can reach out to and say it's really based on your tax ID number. And as you are applying for credit and building business credit, whether it's a line of credit or a loan for your business, it will report to your tax ID number, and we will pull and automatically report to Dun & Bradstreet. So although there is some skin in the game that you have where you can manually add additional reporting for your business score, we're going to report it anyway. And the Dun & Bradstreet number is not the only way for you to build that credit. It's really following you with your tax ID number, your address, and any businesses that you have with the State Corporation Commission. Dun & Bradstreet is just a quick way or an easier way for that resource to help you build credit if you decide you want a partner to roll up their sleeve to help you figure out how to continue, building that score. But you certainly can do it yourself without having a DUNS number. Now, if you're looking to do business with the government and state, I would highly recommend you getting a DUNS number, because you can build on that DUNS number and bid on a contract for the government, and they're going to approve or award you or not award you based on your DUNS number, not your tax ID number. So they're two different things. So I want to encourage you to include the reason why it's important to have a DUNS number, although it's not critical for you to build credit in the business name. Great question.
Next
Sabrina,
question.
we found, may I interject? We found that during COVID with some of the SBA funding that the applicants were required to have a Dun & Bradstreet number too. So if you're looking at maybe emergency funding through SBA or something like that, if that happens again. So it is good to have the Dun & Bradstreet number.
Absolutely.
Thanks, Margie. It says, how do I transfer something from my personal credit that was bought for the business to my business credit?
Basically, you are applying for a business line of credit or a business loan and paying off that debt that was in the personal name. Sometimes lending institutions will or will not allow you to do that. But let's say you apply for a business line of credit. You can certainly take that. And now I advise you to get with your accountant on your bail team and come up with the right strategy of transitioning that personal debt into the business name. But that's as simple as that. You can do like a business line of credit or a loan and pay off debt. And in some cases, in a lot of cases, it might be the personal debt that you had to do in the very beginning because you didn't have a lot of business credit to put it in the business name. Or let's say you had a $50,000 project and you got $25,000, but you maxed out everything in the business name, and then you still need another $25,000. Some of my clients end up doing a personal loan in order to bridge that gap. And then about 24 months later, once they are been in business for at least 2 years and, they've shown strength on tax returns, then they take that personal debt and put it in the business name under a business loan. Great question.
The next question is, should we change our utilities in the business name to the business name to help with the business credit? Like I use the internet for my services.
I would, and I would also get with your tax advisor. A lot of that can be utilized as a tax deduction if you're doing that. And especially if your business is out of your home. Now, I am not the accountant, the attorney, so remember I'm saying this is just educational purposes, not meant for tax advice or legal advice. So that's where that bail team will help you strategize and put what you need in the business that needs to be in the business and talk to you about the importance of why. That's what I'm talking about as far as leaving money on the table. I'm going to give you an example. If you have a business line and you have a personal line, you can use your business line, which you might choose that as your cell phone, as a tax deduction. But you can't use it as a tax deduction if you don't have and can prove that you have a personal line as well. So maybe you get Magic Jet as your personal line and you use your cell phone as your business. So that's an example of a tax deduction write-off on an expense that you probably didn't know about unless you've consulted with your CPA in advance on how to strategize that. So yes, I would, with the right advice from your CPA, touch base with them or your accountant, transition that utilities into the business name.
That was a good question. Next question. Do you require W-2s for business credit?
It depends if you are signing as a personal guarantor, the answer is yes.
Okay. I have a question about pre-qualifications. Is it a good idea to get pre-qualified for loans if you're going to purchase a vehicle or a car or equipment for the business? Are those hard hits or soft hits?
That's a great question. So there's two things I want to bring up. So pre-qualifications for businesses don't work the same in most cases as they do personal. Like, we can get you pre-qualified on the personal side if you need to do a car or mortgage or anything like that. But when it comes to the business, because there's so many factors in approving you for the loan, and that could change conditionally based on whatever you're choosing vehicle-wise as far as value and all of the above, there's a difference. So pre-qualifications are limited. Like a pre-approval letter is very limited when you're doing business loans or business inquiries. But to your question specifically, I think you were asking, what was the second part of that question, Misty? It was,
are they soft hits or hard hits?
Okay,
In a
so they will
pre-qualification.
be hard. Yeah, so it's a great question. It's a hard hit. Anytime you're applying for a loan or a line of credit, it's a hard hit.
Okay. Next question is about equity lines for a business. How are those basically, if you receive an equity line on a business, as far as maybe a building, are those on your credit report as the full amount of the line of credit, or just on what portion of the credit you have used?
Okay, that's a good question too. And that answer can go in different ways because each equity line of credit might be different for different people. So if you have an equity line of credit using a business and it's in the business name, and of course, Fulton Bank is one of the few banks that will allow you to take out equity using property in the business name. Typically, once you put it in the business name, a lot of banks will not let you take out the equity. You can refinance it and take cash out all day long in the business name, but we're one of the few banks that allow you to do that. So a little bit of information about that. But once you put it in the business name, and let's say you've done equity and you've tapped it out, the equity line of credit in the business name, it is not going to show up on your personal bureau. Even if you're personally guaranteeing it, the reason why is because it's in the business name. If you're taking out equity and let's say it's in the personal name, and let's say it's rental property and you have not put it in the business name, that will show up in the personal credit bureau.
Okay. Can you have too many open credit lines with zero balances?
We do, and that's these are really great questions, Misty. I'm so excited. So yes, you can have too much open line of credit. And here's the way the bank thinks of it. We look at debt to income. We take in consideration how much debt you have, and divide that into how much income you have coming in. But let's say you're like, well, I'm debt free and I have $150,000 out there that I can draw from. It's usually not the decision maker. It's one of the factors we'll take in consideration. So if you're debt heavy and you have a lot of open lines and maybe your score is 650 to 680, we might decline you because you have a lot of open lines that you are not utilizing, but you could. The reason why is because you could. So if we approve you for the loan or the line of credit, we know that you have all that other stuff that you can go out and get yourself in debt for. So although it's not usually the decision maker, it is one of the factors we take in consideration.
I have another question that says, I buy houses. Can I use business credit cards for my down payment on an investment property?
Well, if you find a credit card that does not charge you a cash advance fee, sure.
Okay.
If they
And
charge you a cash advance fee, usually it's 3 or 4, or in some cases I've seen them at 5%. But if you do that, look at, I mean, there's usually 0% for so many months, you know, that's out there. But then once that runs out, what is it going to be? 20% if you don't have that strategy to pay off, you know, paying that down payment. The other thing is, you know, the mortgage loan officer is probably going to take that in consideration that you're borrowing for your down payment. There's that conversation. And then lastly, if you don't have that 0% offer, typically it's usually a 19.99% cash advance rate fee that they charge you on top of it. So if you do that, make sure you get with your trusted advisor and come up with the right strategy to review all of your options before you make that decision. So Missy, I'm sorry, I apologize. I kind of cut you off a little bit.
no, that's fine. Thank you. The next question is, does utilization of all or most of your equity line negatively impact your credit score?
So, so the utilization piece, and that's a really great question. It's the first time I've had that question. And Misty, I'll have to get back with you. I believe it is only for credit cards and lines of credit. I don't think it's equity lines. I think I know the equity lines are a factor in the 10% type of credit you're using, but I'm don't think it goes into the 30% utilization category, but I could be wrong with that. I need to research. I don't like answering something that I don't know 100% is correct, so I can get back to you on that.
And that's not a problem. We will make sure that the participant gets that answer through email. So the next question is, do I need an appointment to receive a consultation with you?
No, absolutely not. You can give me a call. You've got my contact information up here. You can email me if you wish. I'm here in Virginia. We can do by a conference, or we can do face-to-face. But I will say this, I try to make an appointment with my clients because I try to be intentional that I'm waiting on them and that they're not waiting on me.
Awesome. Okay. Is there any other questions? If anyone wants to not type it in the chat, you can, if you want to speak directly, that's fine too. Okay. I don't think I see any other questions, but if there is additional questions, you have Ms. Davis's email address. You also get contacts from our office. You're more than welcome to email us with any questions that you might have. So Sabrina, we thank you so much for bringing all this information to us and our clients. We thank each of the participants, and we hope that the information was beneficial. You will be receiving a survey. If you would please fill that out. We like to get those surveys answered so we can see how we're doing and how we can change things and make things better with the information that we're presenting. We will also have another session with using your YouTube to grow your business that we will be offering on Friday at noon. If anyone is interested in watching that webinar, please go online and register. You can find those links and at the SBDC, or contact one of us, and we can make sure that you know how to register that. So if no one else has any further questions, we will go ahead and end the session for today.
Thank you.
All right. Thank you, Sabrina. We appreciate it so much. Thanks, guys. You have a good evening.
You too.